Hello, this is Dr. Adam J. Bach. In this short audio presentation, we're going to begin our conversation about finance, specifically looking at revenue models and profit models. Before we get into this, I want to point out that this presentation should be combined with the Module 5 assignment in Canvas. You can either pause this presentation to complete the elements of that assignment as we go, or you can complete this entire audio presentation, which will be relatively short, and then follow up with the finance assignment afterwards. Also, at the end of this particular presentation, I'll just mention a couple of aspects of harvest or exit, and then in the second lecture replacement presentation, I'm going to walk you through an actual example of a exit event. So when we talk about finance, your textbook specifically refers to 4 areas in which you should understand how technology entrepreneurship ventures actually function. Revenue models, cost and profit models, and then harvest or exit. Your textbook goes through each of these in a little more detail, and you'll want to be familiar with those for quizzes and exams and for writing multiple choice questions. So there are a variety of different kinds of revenue models. Your textbook identifies 5 of them, describes product service sales, which is sort of what we think about in most traditional businesses, a subscription model in which some type of service or product is provided on a recurring basis. It could be for data, or it could be for something like a magazine or some other type of regular service that's provided. Advertising model, obviously one that all of you are familiar with. This is how many online businesses function, where they provide access to a service for free or for nearly free, and in return they sell the data that they provide to advertisers, who are then able to promote products and services to the users. Transaction fees, another model that you may be familiar with, where the purchase of one product or service generates a transaction fee for a separate party. Classic example of this is buying a house through a real estate agent, where the agent gets a specific commission off of the purchase of the home. And then a more modern business revenue model, affiliate sales, where access to customers is provided by some type of third party. So for example, you might be online reading an article about something like mattresses, and at the bottom of the article it says, here's the mattress that received our top rating. If you click here, you can go straight to that company's website where you'll get a 5% discount. In those situations, the website that you're coming from usually gets some type of kickback from the company if you actually complete a sale, and we talk about that as an affiliate revenue model. So what I would like you to do now, or what you can do at the end of this presentation, is the first part of the assignment that you're going to do is to, for each of these revenue models, to identify a company, a product or service that uses the model. And obviously I'd prefer if you didn't use the ones that I just referenced in this presentation. So you can either pause here or you can continue on and complete that later. It's important to recognize that most tech startups are unprofitable. This is a classic chart that you see here from the textbook, figure 16.4, in which there is a period of time during which a early stage venture makes no money and loses a significant amount of money. Some of the reasons that this is the case: many of these organizations have R&D expenses, especially in the case of life science companies. There may be prototyping and subscale manufacturing investments that need to be made. These are much less expensive than they used to be. Rapid prototyping, 3D printing has enabled many tech ventures to get off the ground relatively inexpensively, but there usually are some expenses associated with subscale manufacturing. Setting up sales, distribution, and support, and the general cost of administration and operations are usually the areas that tech entrepreneurs fail to fully estimate or understand. These can be quite time-consuming and quite expensive. In order to get to a point where an organization can sell a reasonable number of its products or services. And so this is where many organizations fail, because they either don't raise enough money, or they simply can't get efficiently from the point where they're still losing money to the point where they're generating enough sales to make money. Because keep in mind, if you look at this chart, sales do not begin at the zero profit point at time t. Sales have been going on for quite some time in this chart, probably at the very bottom of that curve, where the peak negative profit is shown as NP. There could be sales before that, but at the very latest, that's when sales begin. And so there's some period of time during which the organization is making sales but still completely unprofitable. And most entrepreneurs completely miss this in their plans to grow a business. Your book talks through a series of profit models. My own perspective is that there's probably no definitive list of all profit models. This is kind of a good list to have in your mind, and you should be able to recognize these. And if you were given a description, you should be able to match it to a specific type of profit model as described in the book. I'm not going to walk through all of these. Some of them are clearly highly generalized. The idea of Twitter and Square being a quote-unquote new business model, to me, is not a very obvious statement. Square obviously runs off a transaction model of some type, and Twitter primarily off advertising. So calling these profit models as new business models, I think, is a little less than helpful. But many of these you're familiar with. The Blockbuster model does not refer to Blockbuster Video, for those of you who are old enough to know what that is. It refers to the idea of companies where you have a lot of different products or services, but only one or two of them are really big enough and generate the majority of wins. And so significant investments go into those. Other examples, such as a solutions-based profit model. IBM is arguably the great example of that, having been a hardware company for the most part for many, many years, switched over to being a solutions provider during the era of Lou Gerstner. A very famous book that he wrote, I believe was titled Teaching the Elephant to Dance. Fantastic story of how to transition an enormous company from one type of profit model to another. But the bottom line is that it's probably more helpful to focus on the specific mechanisms your business uses to create and capture value. That is, simply picking one of these profit models and saying, okay, we're going to use a brand model. That doesn't mean you're guaranteed to make profits. It just provides you guidance on where value is created in the organization. And really thinking through from a business model perspective, as we did in class previously, how the business creates value, and then whether or not you can actually capture that is going to determine whether you're profitable. Really good example of that on here, Apple. Obviously, hugely valuable brand, but just having the brand alone isn't what creates value for the organization. Apple's success and its brand power have come from its ability to create user interfaces and user experiences that people will pay more for than for comparable products from other organizations. And so if you're going to buy, for example, a Mac laptop, on the whole, you're going to pay more than for a Windows-based laptop with roughly the same specifications. And that's because people who buy Macs have an emotional attachment to the product because of the way that they feel that it supports what they do. I'm briefly going to talk a little bit about why companies should grow. But before I do that, I'll point out that the second piece of your online assignment for Module 5 is to address 3 of the profit models and identify organizations that you believe use those profit models. So this is a good time to pause and complete that part of the assignment. Alternately, you can do it obviously at the end. Companies choose to grow for a variety of reasons. I'm briefly going to walk through each of these. In some cases, founders and managers simply want to have as much impact as possible. If your goal is in particular to commercialize a specific technology, to provide some type of social value, then growth is the only way that you can have the most amount of impact. Obviously, growth can create economies of scale, which can reduce costs. If your organization is going to be competing using a competitive strategy of cost leadership, then in many cases, growth is the only way to develop and retain that particular competitive advantage. Growth creates access to new markets or opportunities. As the organization expands, has more contact with customers, it may then be able to access additional markets or additional commercial opportunities that otherwise wouldn't have been available to it. Sometimes companies have to grow because that's the deal that founders make with investors. They bring in private equity or other investors from the outside, and growth is the only way to generate the kinds of returns that those investors are anticipating. A big reason to grow is to reduce vulnerability to exogenous factors. The simple reality is that large firms are less vulnerable than small firms. This was extremely obvious in the recession of 2008, in which many large firms, despite being in terrible financial positions, were able to get access to outside financing, in particular because they were extremely large firms. And of course, some of them, such as the automakers, received assistance directly from the US government, whereas most small firms had no access to that kind of capital, either through private means, such as banks, or obviously through the federal government. Being large also means that you have more redundancy inside the organization. You're less vulnerable to a single key employee no longer being available to do the job that they do. Multiple people are familiar with processes and so on. Sometimes companies have to grow just to keep pace with industry or competition. If your competitors are growing extremely rapidly, then failing to grow can put you at a competitive disadvantage. And of course, sometimes founders simply want to make as much money as they want, and growth is usually a mechanism to accomplish that rather than staying extremely small. Your textbook walks through the idea of the sustainable growth rate. This is a formula using relatively straightforward financial information to identify how rapidly an organization can grow without access to outside capital. In other words, this estimates how much cash the organization's organic operations generate in order to sustain growth. And the formula is, as you can see, the profit margin times 1 plus the leverage of the organization, that is a measure of how much debt to equity it has, over T, its total assets over sales, minus that same factor. And there's no shortage of resources online that walk through the derivation of this formula. Your textbook explains it in somewhat detail, but perhaps not as clearly as you might otherwise like. I don't expect you to be able to derive this formula or anything like that, but I do expect you to be able to use this formula. And so your last assignment in the Module 5 Finance assignment for this topic is to calculate this for a publicly traded company. And the worksheet that is there helps you see the different information that you need, but you do have to do the calculation on your own. Hopefully this won't turn out to be too difficult for you. You might discover that profit margin is a piece of information that's not always readily available to you, and you might need to calculate that. There are different ways to calculate profit margin, so one of your responsibilities in the assignment is to explain precisely how you calculated it. A good resource to complete this particular assignment is finance.yahoo.com, but there's no shortage of other places you can go. MarketWatch, CNBC, any of the major financial websites give you immediate access to major publicly traded stock information on which you can access the financials. Just use data from a reasonably recent year, such as 2018 or 2019, and then use the information that's available to calculate the sustainable growth rate for the company. And then you'll be submitting that as part of that overall assignment. Last topic I'll mention real quickly is harvest or exit. This is a situation in which some or all of the owners or investors in the company get access to the capital and earnings that they have that have been created. The most simple one is, or perhaps the most common one, is where the business is simply sold, or the assets of the company are sold to another firm or another individual. And all of the owners presumably reach some type of payout, either in stock or cash. An initial public offering is sort of the holy grail of exits. Keep in mind, though, that these are incredibly rare. So here's the statistic to keep in mind. Every year in the United States, more than 500,000 new companies are started. And every year in the United States, less than 200 companies will have initial public offerings. So the likelihood of an IPO for any given venture is unbelievably low. And using this as your explanation for how investors are going to be successful is almost never convincing. Other ways that value can be harvested, Clearly just cash dividends to investors and owners if the company is profitable, and it's then cash can be distributed if it's an LLC as obviously just profit sharing. If it's a C corporation, then as dividends. In some situations, businesses are sold to the management team or the employees. That can be a mechanism by which founders or owners receive some of their cash value generated. And then ultimately, if it's owned then by the managers and employees, then they get the benefit longer term from the value that's created. And then finally, in family businesses, the transfer of the entire firm to family successors is a common way that the family receives some of the benefits. This usually is not a cash transaction, but it can be in some situations depending on what the capital structure of the organization is. So this gives you a sort of a quick introduction to some background of financial issues in terms of revenue and profit and harvest. Finance is a fairly significant topic for technology entrepreneurship. We're going to be spending almost the entire rest of the semester talking about related topics to it. So if you haven't already done so, this is now the time to go and do the assignment and the additional responsibilities in this topic.